Are you worried about navigating overvalued markets? Welcome to Entrepreneurial Edge. Don't forget to like this video and subscribe to our channel for more insights. Overvalued markets can be tricky. Prices are high. Investors are excited. It feels like easy money. But what goes up must come down. Understanding overvaluation is crucial. When markets get ahead of themselves, a correction can be brutal. Remember the dot-com crash? Investors were buying anything with a dot-com. Then reality hit. Overvaluation doesn't mean a crash is imminent. Markets can stay irrational longer than you can stay solvent. But it's important to be prepared. Have a plan. Don't get caught up in the hype. Stick to your strategy. And remember, long-term investors win. The price we pay. A look at today's market. Today we delve into the complexities and nuances of the current financial landscape. The market is a dynamic entity, constantly shifting and evolving, influenced by a myriad of factors. Understanding these factors is crucial for investors, analysts, and anyone interested in the financial world. How do we know if the market is overvalued? This is a question that has puzzled experts for decades. There are various indicators and metrics that analysts use to gauge the market's valuation. One measure is the Shiller PE ratio. This ratio, developed by economist Robert Shiller, is a popular tool for assessing whether the market is overvalued or undervalued. This compares stock prices to average earnings over the past 10 years. By smoothing out short-term fluctuations, the Shiller PE ratio provides a more stable and long-term view of market valuations. Today, the Shiller PE ratio is high. This has raised concerns among investors and analysts alike. A high Shiller PE ratio suggests that stocks are trading at prices much higher than their historical earnings would justify. This suggests stocks are expensive relative to their historical earnings. When stock prices are significantly higher than their earnings, it often indicates that the market is overvalued. Is this a bubble waiting to burst? It's hard to say. Market bubbles are notoriously difficult to predict, and what seems like a bubble can sometimes continue to inflate for years. Some argue low interest rates justify high valuations. With interest rates at historic lows, borrowing costs are cheap, which can drive up stock prices as investors seek higher returns. Others point to strong corporate earnings. Many companies have reported robust earnings, which can support higher stock prices. But the reality is, we're in uncharted territory. The current market environment is unlike anything we've seen before, with unprecedented levels of uncertainty and volatility. The market can remain irrational longer than you can remain solvent. This famous quote by economist John Maynard Keynes highlights the unpredictable nature of financial markets. It's important to be prepared for a potential downturn, even if it doesn't happen tomorrow. Diversifying your investments, having a solid financial plan, and staying informed are key strategies for navigating uncertain markets. Remember, while the market can be unpredictable, being prepared can help you weather any storm. History repeats itself. Lessons from past bubbles. Remember the dot-com bubble? Investors poured money into internet companies, many with no profits. The Nasdaq soared, then crashed. Or the 2008 financial crisis? Easy credit fueled a housing bubble. When the bubble burst, it triggered a global recession. These examples teach us valuable lessons. Greed and fear drive market cycles. When investors get caught up in the hype, they ignore risks. History doesn't repeat, but it often rhymes. Today's market may look different, but the underlying principles remain the same. Investing, not speculating. The Bogle Approach. This method, pioneered by Jack Bogle, emphasizes the importance of long-term investment strategies over short-term gains. Jack Bogle, founder of Vanguard, was a champion of long-term investing. He revolutionized the financial world with his innovative ideas and steadfast belief in the power of patience and consistency. He believed in buying and holding a diversified portfolio of low-cost index funds. This approach minimizes costs and maximizes returns over time, allowing investors to benefit from the overall growth of the market. Bogle distinguished between investing and speculating. Investing, he argued, is about owning a piece of a company and participating in its growth, while speculating is merely betting on short-term price movements. Investing is about owning a piece of a company and participating in its growth. When you invest, you are essentially becoming a part owner of the business, sharing in its successes and failures. Speculating is betting on short-term price movements. This can be risky and often leads to losses. as it relies on predicting market fluctuations that are inherently unpredictable. In an overvalued market, it's tempting to speculate. The allure of quick profits can be hard to resist, but Bogle's approach cautions against this mindset. But Bogle's approach reminds us to focus on the fundamentals. Buy good companies. Look for businesses with strong fundamentals, solid management, and a track record of success. Hold for the long term. Tune out the noise. Market fluctuations and sensational news can be distracting, but staying focused on your long-term goals is key to successful investing. His philosophy is simple, but powerful. By keeping costs low and maintaining a disciplined approach, investors can achieve significant growth over time. It's about taking a disciplined approach and ignoring the siren song of market hype. Stay the course, trust in your strategy, and let time work in your favor. Bogle's legacy lives on through his teachings and the countless investors who have benefited from his wisdom. His approach is a testament to the power of patience, discipline, and a long-term perspective in the world of investing. By following the Bogle approach, you can build a secure financial future, free from the stress and uncertainty of short-term market movements. Embrace the principles of long-term investing and watch your wealth grow steadily over time. Remember, investing is a marathon, not a sprint. With the Bogle approach, you can achieve your financial goals and enjoy the peace of mind that comes with a well-planned investment strategy. Building a balanced portfolio weathering market storms. A balanced portfolio is your best defense against market volatility. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes: stocks, bonds, real estate, and even commodities. The right mix depends on your risk tolerance and time horizon. Younger investors can take on more risk. Older investors may prefer a more conservative approach. Rebalance regularly to maintain your desired allocation. This involves selling winners and buying losers, which can be emotionally tough but is crucial for long-term success. Index funds, the simple path to long-term growth. Index funds are the cornerstone of a Boglehead portfolio. They track a specific market index like the S&P 500, providing broad market exposure. Why index funds? They're low-cost, transparent, and tax-efficient. They outperform actively managed funds over the long term. By investing in index funds, you're essentially buying the entire market. You're not trying to pick winners or time the market, you're riding the wave of overall economic growth. In an overvalued market, index funds provide a disciplined way to participate in potential upside while mitigating downside risk. Patience pays off. A long-term perspective. In the world of investing, having a long-term perspective is crucial. It's not just about making quick gains, but about building sustainable wealth over time. Investing is a marathon, not a sprint. Just like marathon runners train for months, even years to build their endurance, investors need to cultivate patience and resilience. It's about slow and steady growth over time. Think of it like planting a tree. You water it, nurture it, and give it time to grow. Eventually, it bears fruit. Don't get discouraged by short-term market fluctuations. These are like the changing seasons. Sometimes the market will be up and other times it will be down. But over the long term, the trend is generally upward. Remember, time in the market is more important than timing the market. Trying to predict the perfect moment to buy or sell is often futile. Instead, focus on staying invested. The longer you stay invested, the more you benefit from compounding returns. Compounding is like a snowball effect. The longer it rolls, the bigger it gets. When markets are overvalued, it's tempting to sell everything and wait for a crash. This fear-driven approach can lead to missed opportunities, but this is often a recipe for disaster. Market timing is notoriously difficult, and even experts get it wrong. Selling in a panic can lock in losses and prevent you from benefiting from future gains. You might miss the rebound. Stay the course. Stick to your plan. A well-thought-out investment strategy can weather the storms and come out stronger on the other side. And let time work its magic. Over the years, the market has shown a remarkable ability to recover and grow, rewarding those who remain patient. Patience is a virtue in investing, especially in turbulent times. When the market is volatile, it's easy to get swept up in the panic. But those who stay calm and stick to their long-term plan are often the ones who come out ahead. Managing expectations: realistic returns in today's market. In a world of low interest rates and high valuations, expecting double-digit returns is unrealistic. Adjust your expectations accordingly. Focus on preserving capital and generating modest, consistent returns. Remember, even a 5 to 7% annual return can lead to significant wealth over time. Don't chase returns by taking on excessive risk. It's better to earn a lower return with less volatility than to experience wild swings in your portfolio. Realistic expectations are crucial for staying invested for the long haul. Don't let greed and fear cloud your judgment. Bogle's enduring wisdom. Key takeaways for every investor. Jack Bogle's investment principles are timeless. They provide a roadmap for navigating any market, especially overvalued ones. Key takeaways. Keep it simple. Invest in low-cost index funds. Diversify. Don't put all your eggs in one basket. Stay disciplined. Avoid emotional decisions. Think long-term. Ride out market fluctuations. Manage expectations. Realistic returns are key. By following Bogle's wisdom, you can weather market storms and achieve your financial goals. Remember, investing is a marathon, not a sprint. Slow and steady wins the race. Thank you for watching. If you enjoyed this video, please like and subscribe to Entrepreneurial Edge for more insightful content.